Hey guys, welcome back to the Bitcoin Fortress podcast, episode 202. Today is Sunday, February 8th, 2026. We are at block height 935,617, Moscow time 1416, and the current mempool fees are 1, 1, and 2 sats per VByte. Well, folks, this week felt like a full system stress test. Bitcoin nuked down toward the low 60s, bounced back above 70. Miners got relief via the biggest difficulty drop since 2021, and regulators reminded everyone they still want the steering wheel. So, as always, we are going to focus on the signal over the noise for the last week. So, let's jump into it. First up, let's get into markets volatility and what just happened. First up from Reuters, Bitcoin plunges as broader crypto market sheds $2 trillion. That's trillion dollars since the peak. So what happened? Reuters frames the move as part of a broader risk unwind. Bitcoin plunging, heavy liquidations, and the crypto complex getting hit hard. So this is the tuition. Leverage builds up quietly, then it comes due all at once. In Bitcoin terms, though, the network, well, it just doesn't care. Blocks keep coming, hash rate adjusts, weak hands get shaken out. One thing to really emphasize here is price volatility is the cover charge for long-term upside and monetary sovereignty. And of course, if you hold your sats in cold storage in self-custody and you don't have any leverage, you're just fine. It's cool. Everything's cool. Next, Reuters reporting Bitcoin rebounds above 70,000 as risk assets stabilize. So then a sharp rebound, largest one-day jump since March 2023 per Reuters, with risk assets stabilizing. This is why trying to trade the bottom is a great way to donate sats to the market. The most important takeaway here is not up or down, it's market structure. When liquidity is thin and positioning is crowded, moves get violent in both directions. So, if you're a long-term allocator, these are the windows where conviction matters more than prediction. And while price was whipping around, ETF flow watchers were glued to the tape. So moving on to ETF flows and institutional positioning. This from Yahoo Finance. Spot Bitcoin ETFs pulled in $562 million daily inflows after major outflows. Again, reporting 562 million of daily inflows led by big issuers following a nasty outflow period. This is classic retail panic, institutional by the puke. ETFs are now a sentiment amplifier. They don't set Bitcoin's rules, but they can turbocharge short-term flows. For Bitcoiners, ETFs are fine as exposure, but not a replacement for sovereignty and self-custody. Not your keys, not your coins. And even during outflows, one product stood out. And this from investing.com, broad ETF outflows, but IBIT shows inflows. This report notes broad ETF outflows while IBIT showed inflows in that session. This is flight to perceived quality within the ETF wrapper. If flows consolidate into the biggest vehicles, that's not necessarily bullish short term, but it can show how institutions behave under stress. They simplify. Now, let's talk about the real-time Bitcoin shock absorber, miners and difficulty. And moving on to miners, difficulty, and network adaptation. This from the Miner Mag, difficulty set for biggest drop since 2021 China ban. Well, that's newsworthy. Difficulty is projected to drop roughly 11%, biggest negative adjustment since 2021's China ban aftermath. This is Bitcoin's built-in resilience. When conditions get harsh, the protocol reduces the burden. People misunderstand miners. They're not a problem. They're the market's decentralized energy buyers and security providers. The network doesn't bail out miners, it just reprices security until the system is healthy again. And then we got confirmation of the actual adjustment. So Yahoo Finance reports difficulty drops 11.16%, largest negative adjustment since 2021. This is a major relief valve for marginal operators. If you're watching the mining industry, difficulty down and price down equals short-term pain, but it forces efficiency and washes out weak capital structures. And for home miners, myself included in that category, this is a reminder that Bitcoin is anti-fragile. It tightens the screws and then adapts. And who knows, maybe we're going to find a block. Certainly our odds have gone up a lot. And so that's kind of cool. Until everybody plugs in again and then, the hash rate goes back up. Oh well. But not everyone survives the squeeze. CoinDesk put numbers around miner stress. CoinDesk highlights miners under pressure and frames economics around production costs and stress signals. So production cost isn't a floor, but it does matter for miner capitulation and hash rate migration. When the industry gets stressed, it tends to get more decentralized over time. Weaker players exit, stronger, cheaper energy players expand. Next, a story that sounds like satire, but it happened. And so under the category of exchange risk, operational failure, and why self-custody matters, this from Reuters: South Korean exchange BitThumb mistakenly sends $44 billion worth of Bitcoin to users. Reuters reports an internal error in a promo distribution, rapid containment actions, and regulator attention. And apparently, I think a lot of people that got the free Bitcoin just went ahead and sold it too. So, of course, that added to the downward pressure of that we were experiencing already. So, this is the cleanest argument for not your keys, not your coins. And even without a hack, operational risk can break things. Big takeaway for you all is exchanges are not banks. They are counterparties with human processes, bugs, and incentives. Also, regulators will use stories like this to justify more oversight, sometimes for legit reasons, often for power accumulation and control. Speaking of regulation, the U.S. policy machine is grinding again, especially around stablecoins. So next section, U.S. regulation, stablecoins, and the market structure tug of war. First, from Reuters, White House meeting fails to resolve crypto legislation stalemate. Reuters describes a White House effort to mediate between banks and crypto industry over legislation still stuck. The real fight isn't crypto versus the government, it's banks versus stablecoin issuers over deposits and yield. Bitcoiners should see the difference. Bitcoin doesn't need permission. Stablecoins do, because they live inside the fiat legal perimeter. So, expect political theater, consumer protection, my favorite. Language often masks an incumbency protection battle. Barron's and FT both put sharper framing on the stablecoin war. Financial Times stablecoin war, Wall Street versus crypto over the future of money. FT frames stablecoins as a direct challenge to bank rails and deposits, plus global regulatory responses. Stablecoins are the Trojan horse for dollarization, but with private issuers and a regulatory choke point. Banks hate yield-like features because it makes stablecoins feel like better banking. For Bitcoiners, stablecoins are useful, but they're not the end game. They're still someone else's liability. There's also actual legislative text worth pointing to. So, from Congress.gov, Genius Act text, stablecoin framework concepts, Congress.gov hosts the text. It's a window into how the state wants to define and license stablecoin issuers. The moment you define approved issuer, you create gatekeepers, and that's why Bitcoin matters. It's the asset that still works when you don't have the right badge. And regulators are also signaling a shift from pure enforcement to coordination. Baker McKenzie reports that SEC CFTC crypto coordination meeting, background and implications. A coordination posture suggests the U.S. regulatory apparatus is trying to reduce the turf war chaos. Bitcoin's commodity-like profile keeps looking cleaner in a world where the SEC versus CFTC fight continues. A coordinated framework might reduce uncertainty for the broader industry, but it can also centralize control. And taxes are another front where the walls are closing in. So let's move on to taxes and reporting structure. IRS, prepare to file in 2026 digital assets reporting and reminder language. The IRS explicitly reminds taxpayers about digital assets reporting expectations and related requirements. The IRS is making it crystal clear they expect reporting compliance to improve. Bitcoiners should treat this as a prompt to be organized. Cost basis, lots, and documentation matter. A privacy note, though, reporting pressure increases demand for better personal OPSEC, but always stay legal. Don't get in trouble. Now, let's widen out. Europe's regulatory timeline is also sharpening as we move on to Europe, MiCA, and deadlines. AMF, which is the France regulator, warns providers about MiCA transition timeline and orderly wind-down plans. The AMF message to digital asset service providers about being compliant by July 1st, 2026, with wind-down planning by March 30th, 2026, if they can't comply. MiCA is the template for license the perimeter. Short-term, it may consolidate the industry into fewer, larger players. Long-term, Bitcoin flows around obstacles. Self-custody is the escape hatch. One more U.S. government angle, the strategic Bitcoin reserve narrative, is colliding with volatility. Barron's reports that the U.S. Bitcoin reserve loses value, and that's loses in air quotes, after crypto wipeout. Barron's frames mark-to-market losses versus the reserve's starting point and political context. Mark-to-market losses are not the right lens for a strategic reserve. Let's not forget, 1 Bitcoin equals 1 Bitcoin. The bigger signal is the Overton window moved. A major nation-state openly holding Bitcoin as a strategic asset, even if it is seized Bitcoin, normalizes Bitcoin. If governments learn anything from this, it should be, don't trade it, hold it like a reserve asset. That pretty much wraps up the news. So let's take a look now at the Bitcoin podcast universe themes of the week. We'll be using what's showing up across major shows and episode rundowns. The 4 recurring themes this week. The first one, was this capitulation or just the first leg? Price violently dumped and then ripped back. Podcasts are framing it as leverage unwind plus liquidity conditions, not Bitcoin failing, which is common framing reflected in market-focused coverage and show discussions. And of course, I'm starting to see zero price forecasts and, the memes of the guy screaming zero and all this other stuff. coming up now. So enjoy the FUD and stay humble and stack sats. Theme 2, mining stress and the difficulty relief valve. So the difficulty drop is being treated as the key network self-healing event of the week. Miner pain, hash price compression, then protocol adjustment. And again, a lot of miners might be switching over to AI as more stable business. That's fine. That just means hash rate comes off of Bitcoin, which means difficulty adjusts, which means there's an incentive for miners to plug in, and maybe the home miners get a little lucky. You never know. Third theme, stablecoin yield equals the real political knife fight. A lot of discussion is essentially banks don't want deposit flight. Crypto wants stablecoins to behave like modern money, and the White House is trying to arbitrate. So I'm sure they will come to some resolution because there's definitely the political will to see this through. But it will be fun to watch. Get your popcorn. Theme 4, counterparty risk is back in the spotlight. The BitThumb operational disaster is a perfect reminder that you don't need a hack for exchange risk to explode. This week, the podcast universe kept circling the same three truths. Leverage lies, Bitcoin adapts, and the fiat perimeter is where the political battles happen. Next, let's talk about the featured Substack post of the week. This week, it is Charitable Remainder Trusts, which is the third in a series of Bitcoin charitable giving posts that I did this week. A lot of people want to give with Bitcoin, but don't want to do it in the simplest sell Bitcoin, donate cash way, because that can create taxes and reduce impact. A charitable remainder trust is one of those tools that could potentially align. Could be income to you or your family for a period, remainder to charity, and potentially better tax outcomes depending on structure. If you're listening and you care about leaving a legacy without feeding the tax machine more than necessary, go read the post, and for that matter, read all three. The first one is kind of just framing, the second one kind of talks about dApps, and then the third one talks about the different charitable trust structures and donating appreciated Bitcoin, which of course now it's a little less appreciated. But it'll come back, and at some point, you'll have huge capital gains, and so it would be nice to use some of that to create some positive things in the world and make the world better. Also, a quick reminder about my books, Bitcoin Fortress, A Simple Guide to Bitcoin for Beginners, Bitcoin Retirement and Estate Planning, and The Bitcoin Lifestyle. Check those out. Links in the show notes to those, as well as this week's featured Substack post and my YouTube channel, and also everything that we covered this week in the news in the show notes. So check it out. And with that, that wraps up episode 202. Crazy week, but we're getting used to it. If you got value from this, share it with one person who needs calmer signal in a loud market. And remember, the goal isn't to predict every move. It's to build conviction around first principles. And so, with that, I would ask you to stay humble, stack sats, and I will talk to y'all next week. Bye-bye.